Welcome one, welcome all to the Node, brought to you by DeFi University and DeFi Crypto and Airdrops. I am Mike, aka Veteran Crypto, and with me as always is David from DeFi University. How's it going this morning, brother?
Doing well, Mike. Doing well. How are you?
Always doing good. Just getting some tweaks done to the show this morning and looking up some news and got some great headlines to share this morning. But anything you want to share before we jump into the news? Or
Man, I've got my trading shirt on today, and just hodl it. It's going to be a little bit difficult to, right? It's going to be hard, man, to continue to hold if we get another flush out. Looking over here at my charting screen, I don't know, man. I mean, look, we should get some type of a bear market rally, but yesterday we got a little bit of a bounce and gave most of it back. So
yeah.
I'm thinking that we might see Alt-Mageddon at some point this year.
Oh no! don't say that. Not
Okay.
unless. Well, I've been building up some dry powder for some of my DeFi plays. Here, let me put the chat up here. Hey, morning, Jay. How's it going, brother? I've been actually using my DeFi, and I'm building a little bit of my dirty fiat into a bag, just if we see further downside. And honestly, at this point, I have very decent bags of the strong projects I believe in. About the only one that I really want to get more exposure to is Hype. The more that I start diving in, and we got a little bit of news on Hype, I see Hype having legs. I still need to do some more research, not telling anybody to run out and buy it. Anything that we say on here is just our analysis. This isn't financial advice. I'm far from a financial advisor. I'm just, documenting my journey. David is much more of an expert than I am.
I'm just some guy. Don't listen to what I say.
just a guy in a virtual room with a bullish shirt on.
Mm-hmm.
Don't mind me. I'm just a guy. I'm just a dude. So basically, we'll get into it. But let's go ahead and hey, good morning, Ellie. How's it going? So let's jump into the news. So first out the gate, Bitcoin falls below 67,000 as oil surges and dollar strength pressure risk assets. Bitcoin slipped below 67,000 after briefly rallying above 70K on Monday, erased by concerns over prolonged Middle East conflict. So initially, they thought that the war might be very short-lived. They took out the Ayatollah Khomeini, and the people were celebrating. It appears that the government and some of the heads of the Hydra still exist because they're still trying to hold on to power. So they shut down the Strait of Hormuz. That is, I believe it's 30% of the world's oil supply gets moved through there. And they are saying that they are going to attack any ships that come through there. There is insurance for ships, container ships that move oil, natural gas, things like that. But the cost of it makes it cost prohibitive to purchase that, to move those goods through there. So parking off the coast there. And I mean, that's definitely affecting the markets. You sent me a link this morning with Gareth. Do you want to talk about that a little bit? How he longed, or I believe he longed, right, on natural gas.
Yeah, so he's trading. He's asset agnostic, and as I look over here at my other screen, the thing that I'm really watching here is the dollar, because that's a little bit of a flight to safety bid out of DXY over the last couple of sessions here. We're seeing the dollar get real close. Did it touch 100 today? Not quite. It looks like the high of the day, 99.68. So the dollar pushing higher, that could potentially be, a little bit of a risk off trigger for equity markets. So if I'm taking a look over here at, let's say, the NASDAQ earlier this morning was down, I think at its trough, a little bit greater than 2 percentage points, currently sitting off only 1.35% as we speak now. So it has been able to bounce, and the level from which the NASDAQ has been able to bounce is right at that 200-day moving average. But Mike, for us as digital asset investors, if we're watching Bitcoin, we really need to be tracking IGV. IGV is software. And that IGV, it's just the software ETF. And so I'm taking a look
Well,
right now.
I noticed that, or I know that you've been mentioning on multiple shows the deep correlation long term between what you're talking about and Bitcoin. So
Exactly, exactly. And so when I see software bouncing and actually, continuing to tick up, it makes me think that maybe Bitcoin could bounce too. So
we'll
we
go ahead
did.
and put your screen up just so people can see it.
Sure, sure. So here, let me go ahead and share that screen, and we're going to take a look at IGV. So that's trading view right there. We should, in a moment, be able to see this. So this here, this is the software select sector ETF. So this is just an ETF of a basket of different software stocks. Now, the thing that's interesting about this chart is not necessarily its pattern, but the fact that it's been so positively correlated with Bitcoin over the last maybe year or so. So if I just go ahead and throw down BTC, the blue line, on top of IGV, excuse me, that candlestick chart, notice this correlation, Mike. Look at how tightly positively correlated these have been. So when I see this tight positive correlation and then I see IGV getting a little bit of a bid and bouncing here, it makes me think that, okay, well, maybe we could see Bitcoin bounce. And so if Bitcoin actually bounces, where could it bounce to? That's the next thing that I think about. And so that's where I'm going to bring up this chart of BTC. And it's just putting in, just like some chop, basically like in a little bit of a box here. So if I go
Yeah.
ahead and just throw down a horizontal at 72 and a horizontal at the lows at 60, where I could actually do is move this to where I think
Yeah.
there is some resistance. So
Where
right
it used to
there,
be support and it's now probably
exactly.
resistance. Gotcha.
Yep. So just chopping around in this range, but I would expect 74K to act as some type of resistance for BTC. And,
Mhm.
look, it is time for a bounce. It's time for some type of a bear market rally. And,
it's,
you know,
it's and we're definitely due. It's I mean, there's a whole lot of red, and not a whole lot of green. So
yeah, no kidding, man. And, when you take a look at the dollar, so the dollar, this is the flight to safety bid that I was talking about earlier. And the dollar pushing up back above this level of what was very long term support, briefly broken to the downside, and back up above that level of what is again support here. Now, if we zoom out on the dollar, you can see just how long term that level of support actually is. This dates back all the way to 2011. So this is a long-term level of trendline support for DXY, and getting back up above the 200-day moving average is a pretty big deal. So, we're seeing rates actually fall significantly, and yet the dollar is rallying. So if we take a look at rates, here's the 10-year. The 10-year, the yield on the 10-year pushed sharply lower over the last couple of weeks, but seems to have found some support and is bouncing a little bit here. So as rates bounce, you would expect, the dollar to also catch a bid, and the dollar's catching a bid, it seems, because of this conflict in the Middle East. Now,
and
hopefully, that
a flight
is
to safety,
resolved soon. Yep,
and that's a flight to safety. Okay, all right.
exactly.
Well, let's go ahead and jump over to the next in up in the gate. We got Signum CIO sees short-term liquidity squeeze, but intact long-term bull case for Bitcoin. Elevated volatility and potential further price drops stem from liquidity squeezes and sentiment fractures amid Iran conflict, but improving macro data. For example, the potential Fed signals that we talked about yesterday coming later this week, and fundamentals could accelerate recovery. Bitcoin's correlation with gold persists. I don't know if I agree with that. What are your thoughts on that?
Yeah, I don't see the correlation with gold any longer. There were a lot of people that were talking about a positive correlation with gold. If we just throw a chart of gold futures on top of a chart of BTC, I don't see a correlation between these
At
two
all.
assets. Do you?
At
No,
all. I
no,
think
not.
that I think that CIO might have his information, or freaking, the chief information officer might have his information wrong.
Yeah, I think so because these charts don't look anything like one another. And it's funny. Sometimes I read investment banking research from like
Yeah,
Goldman Sachs and guys like that, firms like that. And sometimes their research is not the best. Like, I'll read these reports from, there's some lady who puts together digital asset reports every 2 weeks. And
yeah,
sometimes they're really, really good. Other times, I think maybe she had an intern write them, and I can't quite tell. So,
yeah.
yeah.
Well, here's a little bit of DeFi news. We got DeFi tokens like Jupiter and Morpho outperform amid broader consolidation. While broader crypto consolidates, select DeFi tokens, Jupiter was up 23% on the week, Morpho up 20% on the week. And indices, looks like CoinDesk's DeFi Select up modestly, show gains, bucking the trend. Hyperliquid hit $14 million of weekly, up 56% week over week, highlighting resilient activity despite macro pressures. So, one thing that I looked up was I was wondering why potentially Morpho and Jupiter was seeing pumps. So, mid February, we did get news about Apollo Global Management and Morpho. So, Apollo, managing $900 billion of assets under management, agreed to acquire up to 90 million Morpho tokens, which it amounts to about 9% of the supply over 48 months via a cooperation agreement. This supports Morpho's DeFi credit lending markets. We talked about this yesterday during our education portion and signals deeper TradFi involvement in DeFi, decentralized lending infrastructure. So this is what we keep talking about, that these institutions are investing heavily into these more established, more respectable DeFi protocols, that have these vaults, these curated vaults and, things like that that are specifically built for institutional management, because these institutions curate, like David was talking about yesterday, they curate these vaults. So they actually, manage these assets in these, what they're calling vaults are traditionally called funds. And it's a basket of assets. And so it mitigates the potential downside because if something slips, something else is probably going to pump. They build these out so they're the yield that they generate is more steady. Am I correct in that, David?
Yeah, more yield. It's always about the more yield. And
Yeah,
I mean,
MOR. MOR
it,
spells.
MOAR always. But I'm
Mhm.
taking a look over here at Morpho, and I didn't realize it, but Morpho just since the lows that were put in back in early, it looks like here, what was that low? That low was put in early February. Morpho has rallied by 100%.
Yeah,
It's actually performed really, really well compared to just about every other digital asset, and it's trading above its 200-day moving average. That's a pretty positive indication. Now, there is a level of resistance quite a bit higher at $2.84. And, even though Morpho has rallied
that
by so
is,
much,
well, isn't that the previous all-time high or close to it?
so the all-time high, it looks like on these data from OKX, comes in at
Oh,
$4.18.
okay.
Yeah, that's what I see on these data. So, the next level of resistance on the upside for Morpho is all the way up there, $2.87. It's currently trading at $1.88. So that would be another dollar higher. And it's already rallied by 100% from its lows on, it looks like Friday, the 6th of February at a dollar. So it's
Yeah,
up from a dollar all the way up to $1.88 in just the last month, as just about everything else has either cratered by 40 or 50%,
yeah,
or done nothing and moved sideways. So kind of interesting to see that. And then if I take a look here at Jupe, that was the other one that you mentioned, Jupiter. So the Jupe token JUP looks like dog shit. The chart doesn't look good, man. Um,
well,
so
it's up, but but yeah, overall, I'm sure it doesn't look well good.
yeah, it's up 37% from its lows, the beginning of Feb,
Mhm.
but it doesn't look anywhere good as anywhere even close to as good as Morpho does.
No, no. I mean, if you bought the bottom, beginning of February, but if you bought Jupe, back when everything was pumping, you're well down. But the news about Jupiter that I found was Jupiter and NOAA partnership enabling regulated bank fiat crypto cross-border transactions within Jupiter's DeFi platform, which as people know is on the Solana chain. This addresses the last mile fiat on and off ramps for $50 million or 50 million plus wallet users, particularly in the Asia Pacific theater. Sorry, I know that's not a term used in finance. It's a term used in the military. Blending DeFi with compliant banking.
Huh.
So this is what Ripple was talking about doing, was cornering the market for cross border payments. So it goes to show you that this is, and I don't believe that Jupiter or NOAA has anything to do with ISO 20022 or anything like that.
No.
So again, it's that whole ISO narrative, it really isn't the thing. It's
It
I
seems to be, yeah, it seems to be dying. I mean, so think about all those tokens. Can you give me a list, Mike, of like the most famous ISO coins?
I
Of
can
course.
rattle them off. I was invested in all of them. It was XLM, HBAR, XRP, Algorand. Those were the major ones, and
Okay,
I
so
was invested in all of them.
here I've got. Why don't we run through some of those ISO coins just
Okay.
real quick? You
All
want to
right.
do that? Yeah,
Yeah,
here
yeah, go ahead.
let's do this because, man, I'm willing to bet that most of these charts don't look too hot here. So I've got Stellar XLM. That's the first one,
Yep.
and I'm sharing my screen here, so I just want to
Okay.
want everyone to be able to see these digital assets, these ISO coins. So why don't we start here just by taking a look at these on a weekly? Okay, that way we can get all the data.
That is
And
not a good chart.
yeah, this doesn't look too hot. Just like most other digital assets, especially the alts, XLM looks like it's about to, over the next couple of months,
Mhm.
retest its lows from the beginning of the bull, the end of the last bear market, down here at like 7 cents. So currently trading at 15 cents, that means to me, hey, maybe there is an opportunity for another 50% on the downside for XLM. What about H bar? Let's take a look at H bar. That's another one of those ISO coins, right? And notice how similar the pattern looks to XLM. Looks very, very similar. And trading below its 200-week moving average, if we just go ahead and mark the lows from last bear cycle, that's all the way down there at 3.6 cents. And this thing's trading right now for 9.5 cents. So, that implies like 60% downside potential. So, you could definitely make some money getting short H bar, especially if we get a bounce over the next couple of days, maybe the next week, we get a bounce, use that bounce to get short H bar. What's another one? Our best buddy over here, XRP. Hi, XRP. Yeah, man. So,
I I was telling people to get out of XRP. I sold all mine. I had about 40,000 XRP, and I sold it all at $2. My average buy-in was about 34 cents. I sold it all at $2, and I was telling people get out, get out, get out, get out. It did get up to like 3 and change. No, I didn't call the top. I'm not going to claim I did, but yeah, I was telling people to buy. Like in leading up to me selling at $2, and it definitely when it was getting to like $3. But go ahead. Sorry.
yeah. I mean, look, sometimes it's just about making money and you're not really thinking to yourself, oh, I need to be right. You don't necessarily need to be right. You just need to be able to make money here. So, what I see here for XRP is if or when it breaks below its 200-week moving average, I think we're going to see alt Mageddon. And, I think we might see XRP down here at 30, 35, 36 cents, something like that.
Back to its point of origin.
Exactly. Exactly.
Because that's where it was trending the whole last bear market was in the 30s. It was just trending sideways in the 30s.
Yeah, well, I think it might just be a matter of time until it gets back down there into the 30-cent range. So, we took a look at XLM, we took a look at HBAR, we took a look at XRP. What are some other ISO coins?
Algo.
Algorand. This was a big one last cycle.
Jay says, "Algo shit. I'm broke."
Yeah, man. Well, Algorand, pushing down to lows never before seen. So, what is this trading for right now? It looks like 8 cents, 8.6 cents. No reason why this couldn't trade for 2 cents. I mean, there's no support in the downside now. So, this can go, it could go to 2 cents and then it could go to 0.002 and then 0.0002. So, yeah. What's another one? So we XRP, HBAR, Algorand, XLM. What's another one?
I found a clip that's appropriate.
Great.
How can I help you, young man?
I got a $100 check from my grandma, and my dad said I need to put it in the bank so it can grow over the years.
Well, that's fantastic. A really smart decision, young man. We can put that check in a money market mutual fund. Then we'll reinvest the earnings into foreign currency accounts with compounding interest, and it's gone.
What?
It's gone. It's all gone.
Yep.
What's all gone?
The money in your account. It didn't do too well. It's gone.
What do you mean? I have $100.
Not anymore, you don't. Poof.
That's what's happening with ISO tokens right now.
Unfortunately, yes. And it all because that narrative, Mike, was faulty to begin with. The whole idea that, that ISO standard had anything to do with, the way that, or normal people or institutions were actually going to settle cross-border payments. Just because that was the standard for SWIFT back in 1970 doesn't mean that that's going to be the standard moving forward.
No, because I mean that's basically was the the whole basis of that that technology. But let's go ahead and drive forward. So we got SoFi and MasterCard partner for SoFi USD stablecoin settlement. So those that don't know, that one of my favorite little house coats that I'm always wearing, that little hoodie that has SoFi on it. I actually worked for SoFi for a while, but it's a neobank. It's and actually have really great offerings. I mean, if you have student loans, I am not affiliated with them in any way whatsoever, but I know that they offer refinancing of student loans at much lower rates. So if you're out there and struggling with student loan debt, you might want to take a look at it. I haven't looked recently, but they do really well with stuff like that. They're very, very fair with a lot of their loans and things. But anyway, I digress. So SoFi is fully reserved, so fully compliant with the Stablecoin Act. USD stablecoin, SoFi USD, now enables settlement across MasterCard's global network, marking a step for bank-issued stablecoins on public blockchains and potentially boosting DeFi TradFi integration. So that's a further movement forward of the integration of TradFi and DeFi with credit cards. TCS, blockchain, and PayPal advance freight invoice flows with PYUSD. So that's PayPal's stablecoin. The collaboration scales blockchain-based settlements for trucking and transport, targeting over 1 billion in annual flows via TCS token and PayPal USD stablecoin, highlighting real-world DeFi utility adoption. In DeFi news, in traditional finance, global stocks plunge, futures sink sharply as Iran war enters fourth day. U.S. futures, the Dow is down about 800 points, is what this is saying. Is that correct?
Yeah, so earlier this morning, that was correct. Let me just go ahead and take a look. Currently, the Dow, I'm just looking for Y, that's the futures, It's down 740 points or 1.5%.
Okay. European Asian indices tumbled. Kospi is down 7%. And the Nikkei, isn't that the Japanese?
Yeah, the Nikkei. Yep.
The Nikkei is lower amid fears of prolonged energy disruptions from the Strait of Hormuz. Iranian retaliation across the Gulf, including U.S. embassy drone strikes and no de-escalation signals. Defense stocks rose modestly. We have oil surges 8% to multi-month highs. Gas prices spike on supply fears. This is what I was talking about with the Strait of Hormuz and 30% of the global oil supply and fuel supplies, going through that area. Brent crude topped $82 to $85 a barrel, up 13% since the weekend. European gas up 35 to 40% amid the Hormuz halt, and Qatar liquid natural gas issues, driving inflation worries and bond sell-offs.
Yeah, Mike, I'm looking over here at the Nikkei, and that's what a real correction looks like. Down 5.26% today. So
want to share that?
Sure. Yeah, the Nikkei not looking too hot. But this could just be a buying opportunity for anyone who has access to Japanese stocks. So here's the Nikkei, and it had, since those April tariff tantrum lows, the Nikkei had basically just gone straight up, just like the S&P. So if we throw down support here, see that level of support? Now notice, where did price find support today? Right. Looks like the thing bounced off there. So if you see that level of trend line support, that is I need to share my screen again, Mike. Is that so it always does that. StreamYard always cuts me off. I think that it might just be something with my computer, not quite sure. But what I do see here is a level of trend line support for the Nikkei that is getting tested today. So this level of support, notice, down today by greater than 5%. That is a really, really big move for a large equity index like the Nikkei. Just for comparison's sake, if we take a look at the S&P, this is the futures, S&P futures, and S&P futures down today by only 1.36%, although they were off by nearly 2% earlier this morning. So it has spent the last couple of hours here rallying. If we zoom in on the S&P, got a really, really big bounce that came in over the last 2 hours here. So continuing to put in a little bit of a bounce here on the S&P. What were some of those other indices that you mentioned there, Mike, or commodities?
So Brent crude.
Okay, so we can take a look just at WTI. So this is West Texas Intermediate crude, and big move over the last couple of sessions out of WTI. Now, notice the level of resistance that I've got highlighted here. So if I just go ahead and remove these two arrows, I'm going to grab another one, and you see right there, that level of resistance at 78.50. That's an important level because it acted as resistance again today. So that level of horizontal resistance continues to hold for crude. And, it might actually be an interesting short play here, because if you want to trade, the potential mean reversion in crude, see, here's the thing. There's no way that the White House in a midterm year is going to allow crude to pump to $100 a barrel.
That's something I wanted to touch on is, and I don't fully understand what I'm about to say, but I know that this is a fact. And please correct me if I'm wrong, but the balance, the equilibrium for oil between governments wanting to keep the price down for healthy economy and for oil companies to remain profitable and that sort of thing, is the range is like in the $80 range. They like to keep oil in the $80 range because it's that nice balance between the two. And if you don't think that oil companies are in bed with our government, you're not paying attention. So, it's a symbiotic relationship. They understand they need to make profits, but not too much, because if oil prices go too high, we rely on oil for everything. It's in everything. It's in our packaging. It fuels how things move. It is in medical supplies. It is literally in everything. So
Yeah.
they can't allow it to go any higher than that range. So
It's an important input cost. So if energy is up at $100 a barrel, that is going to feed through to inflation in a couple of different ways. Now, what I see here is actually a potential short signal. I see an opportunity for mean reversion back down to what I think is a level of support. So notice this long-term trend line here. This was resistance. So oil rallied from $55 up to resistance at $67. And then we got the beginning of this war in the Middle East, and crude oil pumped. Now, we're seeing another bounce today, but notice where resistance is, right at 78.5. So that level of resistance, you could, trade that. You could get short if oil gets back up to 78, or you could even get short right now. And the trade right now, if we zoom in, would be back down to trend line support here. So if I just grab my arrow.
What would the percentage be on that? Like if you shorted right now and it made it back down to that level of support, that trend line?
Maybe 10 or 11%.
That's an awesome, quick trade.
Exactly. And you don't have to use any leverage. So it would be something like you're either right on direction or right out of the trade. So this would be your stop just above resistance. You could enter here. And if you're wrong, okay, you get taken out right here. If you're right, then you take profits down here. So you're either right on direction or right out with a tight stop. So I kind of like that, getting short crude here.
Yeah. All right.
Yeah. Interesting little trade setup there. I like doing this stuff live. What about nat gas? Because Mr. Gareth Soloway was talking about trading some nat gas here, and hey, we are seeing natty gas pick back up a little bit here. This big move that was during that polar vortex a couple weeks ago.
You shut down share again.
Oh man, see it does that, Mike. StreamYard. I think it's probably just my computer actually. I think so. Yeah, I think so. I need to restart the thing. But so we had a little bitty bounce here out of nat gas, from $2.79 all the way up earlier this morning to $3.17. So that's actually a pretty decent bounce. If we measure that with this tool here, that's a 13% bounce over the course of just the last 3 sessions. So pretty big bounce out of nat gas. Now, if we zoom in a little bit just to see, are there any potential opportunities that are shaking up here? Let's just throw down some trend line resistance. Okay, so I'm going to use this as the anchor point and drag that trend line down. We are getting a little bit of a breakout. So you could play the breakout on the long side here in natty gas, and you would be trading that up to the 200-day moving average here at $3.55. So again, this is a pretty big contract if you're going to trade it like in a traditional account, like CME futures or something like that. These are actually NYMEX futures, but this is a big contract size, nat gas is. So, you would trade it like a one lot, like really, really small. But a 13% move on a one lot contract in nat gas, dude, you're going to do really, really well. Like though, if you're right on direction, these futures, because they're so big and the tick sizes are all, pretty decent. You could do really, really well on a 13% move to the upside out of nat gas. And it can do stuff like that in a heartbeat. So really what you got to be watching here is, not just the Iran stuff, but also weather. And since it's the beginning of March, I don't think that we're going to get some type of a cold spell. So if there's no cold spell, and if the stuff in the Middle East resolves, then you would actually expect this breakout to fail and for nat gas to move lower. So whatever risk premium is going to be built in, geopolitical risk premium might get built into the price of nat gas. you could trade that on the long side, and you would have a pretty tight stop. If you were to zoom in here, let's just take a look at this. This is a daily. I want to zoom in a bit further to a 4-hour so that we can see where you might set a stop here. And let me just bring this into view so that we can all see this a little bit more clearly. Okay, so here's the breakout. See this big breakout? So you could say to yourself, hey, you know what? I want to get long on a retest. But if you don't get the retest, you could enter the long position here and then set your stop below this level of trend line support. So your stop would come in something like right about right there. And then your take profit level would be all the way up here at the 200-day moving, or that's actually the 200 period on the 4-hour. The 200-day moving average comes in even a little bit higher, I believe. But, basically you're either right on direction, or if you're wrong, you set a tight stop. So right or right out. Kind of like that on that gas.
What would be on that stop loss? What would be the loss on that percentage wise?
So the loss in percentage terms would be 4.5%.
Okay, so I mean that's not bad. I mean, if you're if on average, if you're trying to take 10 to 20% take profits, and every once in a while you're taking a 4% loss, net, as long as you're winning more, twice as much as you're losing, you're going to be net positive.
Yeah, so I just think to myself in terms of risk and reward. So the risk here, you'd risk 4.5 points to make 14.5 points. So you're risking 1 to make 3. Yeah, not a bad risk reward there, in my opinion. No. It's just that the nat gas contract, the contract size is really big, so that can be prohibitive for a lot of traders. So I'm probably just going to end up watching this one from the sidelines.
All right. Yeah. Let's go over the macro. We got 2 headlines in the macro, and then we'll go ahead and kick it over to our education portion of the show. So Iran conflict escalates, strikes on Tehran and Beirut, missiles hit Israel, embassies closed. Israel conducts simultaneous strikes in Tehran. I don't know why I'm having a problem saying that. Specifically at leadership sites. So it's not just a mass bombardment; it's surgical strikes. And Beirut trying to target Hezbollah. Seizes southern Lebanon areas. Iran launches missiles at central Israel. Closes the Strait of Hormuz. Attacks the U.S. and allied targets. Riyadh embassy with drones. U.S. closes embassies in Saudi Arabia and Kuwait. Urges evacuation from 14 countries. Trump singles operations could last weeks. UN confirms nuclear facility damage in Iran. The other headline is oil-driven inflation fears grip bond markets. Traders slash rate cut bets. Surging energy prices fan inflation risks. Eurozone headline up to 1.9%. Core up 2.4%. ECB and BOE easing. Emerging markets face added strain from currency capital flow pressures. So let's discuss inflation a little bit for the next couple of minutes before we go into the education portion.
Yeah, so inflation is always a boogeyman. And see, here's the thing: if we're about to see energy really persist higher, if energy is going to continue to push higher, well then we've got to check in on CPI inflation. If we see this start to turn up and tick higher, that would be, a big warning sign. And that's why, you might actually see all of those rate cuts get taken off the table this year if inflation really starts to tick back to the upside. And what could drive inflation higher? Well, higher input costs. So if all of a sudden energy is, at $100 a barrel, if crude's at $100 a barrel, and this is just the WTI contract. So let me go ahead and mark $100 here on the contract so that we can just see that right there. So that orange level, that is $100. And down here, that blue level is $55. So if energy continues to push up to $100, well, that could feed into inflation. And it looks like, Mike, did you, my screen popped off there for a second, the screen share. So
Yeah.
oh, okay. Yeah, gotcha. Yeah, this screen share thing, that's okay. So $100 a barrel, that's really the warning level. I just don't think that the Trump administration is going to allow that to happen. And I also think that Iran is being dealt with. And so whatever that geopolitical risk premium is that's being baked into the price of energy right now, I think that's going to bleed out. I'm not expecting there to be more escalation. From what I've seen, Mike, it looks like the US military has conducted thousands of strikes on Iranian weapons facilities and just degrading their ability to wage war at all. So I think it probably is just a matter of time until that regime is so degraded that they don't pose a threat to anyone any longer. And so that would mean that we'll see the risk premium bleed out of energy. So it might be a better trade just to wait for crude and nat gas to pump a little bit more and then get short. That might make sense, I think.
Okay. All right. Well, we got about a little over an hour left on the show, so let's go ahead and see what you got for us as far as education. Investing education, DeFi, that portion of the show.
Sweet. Looking for some education.
Education.
Trying to get educated. So
yeah,
I'm thinking, Mike, that some investor mindset stuff might be a good idea. Now, here's the thing. I published all of these courses as books, paperback books and ebooks, and they're available on Amazon. And so whenever I take a look and see like who's buying what, well, I put these courses in order for a reason. You start with the investor mindset course, and then you go to liquidity provision, money markets, and perpetual futures at the very end. So the perpetual futures book is the one that sells the most, but you can't trade perps well if you can't control your mind. And so that's why I think it's super important to begin with the investor mindset stuff. So
well, everything should be built from the foundation up. When it comes to your education, your knowledge, when it comes to, physically, you're not going to build a house. You're not going to put start building the roof and then, build the walls and, then build the foundation. You don't want to get ahead of yourself. So, yeah, you have to develop the discipline, to be able to control your emotions, to be able to, focus on facts and, not FOMO and, all those things before you get into actually deploying capital, deploying liquidity. So,
yeah, no kidding, man. And, here's the thing. When you really start to learn about risk management, you'll start to understand that it's really 80% psychology and only 20% math. Most of what we do as traders is about mastering our minds and mastering our emotions. And that way we can master risk. So let's play this video content. This should be pretty good. I'm going to go ahead and open this up. Here, Mike, let me know if you can hear this. In fact, I might have to stop my screen share and start it again one more time just so that I can enable audio on the tab. Okay, great. So audio is sharing on the tab. This should now work. Here we go.
All right, welcome to The Explainer. Most people think trading is all about picking winners. It's not. The real game is about how much you bet when you're right, and more importantly, how little you lose when you're wrong. Today, we're going to decode the system that separates the pros from the gamblers, the psychology of position sizing. Let's just start with the most important concept right off the bat. The real battle you're fighting isn't against the market, it's the one happening inside your own head. This quote says it all, right? Your success isn't about some fancy spreadsheet. It's about whether you can manage your own mind when the pressure is on. So why is this psychology stuff so hard? Well, it's because your brain is literally at war with itself. You've got what Nobel laureate Daniel Kahneman calls System 1. That's your fast gut reaction brain that runs on fear and greed. And then you have system 2, your slow analytical brain that actually calculates risk.
Okay, so I built this investor mindset course based on 12 books. And all of those books, you can see the reading list in the school community at school.com/DeFi University. But this is based on one of the books by Daniel Kahneman. I think he's Daniel Kahneman, PhD. I think he's also a Nobel laureate. And he wrote Thinking Fast and Slow. I believe that's the title of the book. Describes the fast emotional system 1 and the slow and logical system 2. And now, when we take risk, it's not even about trading necessarily. It's just about risk-taking behaviors. When we take risk, this fast emotional system 1, it fucks us up. Okay, like what it does is it tells you to do exactly the wrong thing at exactly the wrong time. So this fast system 1 will lead to emotional decision making. This is what you want to avoid. And that's why you build a plan and a system using the slow analytical system 2. And that way you already have a plan in place so that when things move against you, you know exactly what to do. And when things move in your favor, you know exactly what to do. The only way you can get to that point is if you work based on that slow analytical system 2. Because if you work from the system 1, you're going to wreck yourself. So just wanted to point that out there.
The problem? When the market goes wild, that emotional system 1 completely hijacks the control panel, leading to disastrous moves like panic selling at the bottom or FOMO buying at the top. And that leads us directly to the heart of the matter. The real fight here is internal. It's you versus you. It's not about being smarter than the market. It's about being smarter than that emotional, impulsive version of yourself. The whole key is to create your rules of engagement while your calm, analytical brain is still in charge.
Right.
Look, here's the bottom line. We're not trying to be fortune tellers here. That's a loser's game. We're trying to be professional risk managers. This whole framework is designed to give you a system to control your own behavior when things get chaotic, so you can move from making emotional reactions to executing a professional plan. Okay, so let's get specific. Before we can build the right solution, we have to diagnose the problem. And the research shows there are really 3 main types of risk that are probably hurting your portfolio right now. First up, we have the most dangerous one of all, ruin risk. This is the absolute account killer. We're not just talking about losing money. We're talking about losing so much that you get knocked out of the game for good. It wipes you out.
Okay, so here's the thing. There are 2 different types of ruin risk. There's the emotional ruin risk, and then there's also, the account level, so the capital ruin risk. And so you've really got to be careful, because not only can you lose all your money as a trader, but you can lose enough that it ruins your mindset. So you can ruin your emotional mindset, and that can make it impossible for you to continue, even if you haven't lost money. So just keep that in mind. There's, it's 80% psychology. It's only 20% math.
Not just financially, but psychologically, ending a trading career before it even gets started. So let's do a quick gut check. I want you to be brutally honest with yourself. If your biggest position right now went to 0 tomorrow, would you be devastated? If your immediate calm answer isn't, yeah, I'd be fine, then your position is just too big, period.
Okay, so this is one of the... Yeah, Mike, go ahead.
So that's what she said?
So, I mean, here's the thing, man. Your body is going to tell you if your position sizing is too big. So there's a bunch of things that, novice traders do, or just normal human beings do when taking too much risk. Here's an example. Have you ever caught yourself, compulsively looking at your phone, checking charts 24/7? Well, that might be a sign your position size is too big. Have you ever caught yourself being unable to sleep because you can't stop thinking about the position that you've got on? Well, the position might be too big. Or have you ever caught yourself anxiously worried that maybe you're out somewhere and you can't check a chart? You've really got to get back and you got to compulsively look at that chart. Well, maybe you're using too much leverage. Again, position size too big. So your body and your mind are going to react in a certain way to taking risk. And once you learn how your body and your mind react, well, you can build a system around that. And at least that's what's worked for me. So
Next up is the silent killer, emotional risk. This is when a position gets so big it literally poisons your thinking. Fear and greed completely take over, and all your rational analysis goes right out the window. Your portfolio stops being a tool for building wealth and becomes this emotional prison. So, how do you know if you're a victim of this? Well, here's a dead giveaway. How often are you checking your phone, looking at your portfolio? The more you check, the more emotionally compromised you are. A great rule of thumb from the research is if you find yourself checking a position more than 3 times a day, it's way too big for your mental well being. And finally, you've got the flip side of the coin, opportunity risk. This is the trap of betting so small that, look, even when you're right, it barely moves the needle. And that just leads to frustration, right? It causes you to overtrade and eventually take on some crazy risks out of sheer desperation to see some real returns.
right.
Okay, enough with the problems. We've diagnosed the 3 ways that risk can absolutely wreck you. Now, let's build the solution. Let's talk about the professional framework for sizing your positions based on logic and conviction, not on gut feelings and emotion. This table right here, this is the heart of the whole system. Think of it as your new rulebook. It's simple. You score your conviction in an idea on a scale of 1 to 10, and that score gives you a hard, non-negotiable cap on how much money you can put in. A proven, battle-tested 10 out of 10 idea? Great, 5% max. A more speculative bet? You're capped at 1%. And if your conviction is less than a 5, you don't put a single dollar in. No edge, no trade.
So notice here, Mike, even if you have a 10 out of 10 conviction score and you're deploying into a proven, battle-tested protocol, well, that doesn't mean 100% of the portfolio. That means at maximum 5%. And the reason why you size positions in this way is so that if you're wrong several times in a row, you don't go to zero. Okay. So, it's all about math at this point. Once you start to control that emotional side, then you can start to think about, well, how large do I need to size these positions in order for them to be meaningful when you're right? But also, where do I cut my losses so that if I'm wrong 5 times in a row, I don't lose half of my portfolio or something like that? So, position sizing, setting stops, and also sizing positions so that when you're right, the outcome is meaningful for your account. That's important. And that's the math part. But that's the 20% part. The 80% part, that's the mindset stuff. So,
And before you pull the trigger on any trade, you have to run it through these 3 simple psychological checks. The biggest one, the one that never lies, is the sleep test. If you're lying awake at night thinking about a position, it's too big. It's that simple.
yeah.
If a trade fails any of these tests, you have to reduce the size immediately.
So, one thing that I've learned about myself, Mike, is that I am much.
Talking about positions and sizes.
Yeah, man, big size, bro. But what I think is, yeah, I found out that my mind reacts best to trades when I'm on both sides of the market. And so all that means is, I might have a directional bias, but I've taken a position on both sides. So if I'm trading,
and that's what you're talking about when you talk about creating, quasi delta neutral positions, correct?
yes, exactly. And so, I like to trade spreads. So if I'm trading, different types of option spreads, maybe with a little bit of
Investing. Talking about size and positions and
talking about spreads and
talking about spreads.
yeah. So these option spreads allow you to express a directional bias if you choose to, but you can also take a position on both sides of the market. So you could be long and you can be short, but you can lean in one direction or the other a little bit. And so that's the type of trading that works best for my mind. But maybe someone else is successful as a directional futures trader. That just doesn't really work for my mind. So you'll find that out as you start to trade and pay a little bit of market tuition, learn how your mind reacts to taking risk, and then build a system around that works for you.
No questions asked. All right, now let's build that safety net. These are the rules you create before the emotional storm hits. This is what's going to protect the rational you from the irrational you when things get crazy. The idea here is to literally make a contract with yourself for every single position you take. It forces you, while you are calm and logical, to define everything up front: your entry, your size, and most importantly, your exit points, both for taking a profit and for cutting a loss. You write it down, you commit to it, and you don't deviate. Now, the absolute bedrock of this whole contract is the 2% rule. It's so simple, but it is incredibly powerful. By never risking more than 2% of your total account on any single idea, you guarantee your survival.
Right.
Think about it. You could be dead wrong 10 times in a row, and you'd still have 80% of your capital left to keep fighting.
Right.
And this isn't...
See, that's the basic math of risk management. As long as you size your positions properly, such that if you're wrong several times in a row, let me go ahead and back this up here a little bit. I want to just get to that. So as long as you size your positions appropriately, number one, and number two, set stops so that you can't lose more than 2% per trade, well, then you can be wrong 10 times in a row and still have 80% of your capital remaining. It's about being able to survive to fight another day.
In a row, and you'd still have 80% of your capital left to keep fighting. And this isn't just for single trades. You have to pre-program your response for when your whole portfolio takes a hit. When your account hits these drawdown levels, these actions are automatic. There's no hoping, there's no debating. Your portfolio is down 20%, you cut everything in half. Down 35%, you go to cash and you take a break. It takes the panic right out of the equation.
Okay, so this is what I did on October 10th. So on October 10th, I was levered long. Now, thank goodness I had a big hedge in place. But after suffering that loss on October 10th, you know what I did? I went to cash and then I stopped trading for several weeks in order to just reset and journal and reflect on what had happened, the mistakes that I had made, the things that I did right, so that I don't repeat that mistake ever again.
And clear that emotional slate too. You know,
exactly.
I mean, it happens to the best of us. I mean, I'm one of the most unemotional people, or emotionally disciplined people that I know. But there's times where it gets to me. You know, I mean, there's times. I mean, my portfolio's down right now. My DeFi portfolio and overall portfolio. But there's some times where I need to pump the brakes a little bit, and I need to reassess because I'll get emotional if there's like a big dump and I'm like, oh, well, maybe I should get out of this. I should, go over here to, because this is pumping. And I have to tell myself, no, calm down. It's good. I did my research. Fundamentally, things haven't changed. These, different projects and protocols, still building, still, these, strong partnerships, actual, investment is flowing. Tokenomics are good. Nothing has changed fundamentally. You hold what you got.
Yeah, sometimes it's really valuable to reassess a thesis, an investment thesis, and just say, hey, has anything changed? I'm looking at my positions, maybe they're down, and I'm asking myself, well, has anything fundamentally changed here? And if the answer is no, well, okay, great. But if the answer is yes, then it might make sense to, cut a loser. Look, your first loss is always your best loss, because in crypto, even if you're down 90%, you can still be down a further 90%.
And you don't have to like totally exit the position. You can just do a portion of it and move that over someplace else, and you can keep a moon bag. I mean, if you have to decide based off the project and whatever whatever your research your due diligence, whatever your findings are. I mean, is it you feel it's a totally dead project? You might want to get totally out. If you feel like that there's still hope for it and you want to keep some exposure to it, keep like 5%, or something like that, and move 95% over into Bitcoin or Ethereum, or maybe it's fiat. It's you need to decide what that is, but it's okay to get out of these projects. Don't get sucked in to those echo chambers and these crypto projects, especially where they just sit there and hype each other up in these chat rooms and in Discord, telling each other how rich they're going to get if they just hodl. It's do research.
Well, I am wearing a "Just Hodl It" shirt, so maybe that has to do with just Bitcoin, though. Okay,
Yes, yes.
I think that we're going to see, like, at some point this year, like, real, true capitulation. So that would mean, alts altcoins down from here an additional 60 or 70%, for the vast majority of them, and Bitcoin down to, maybe 35K, something like that, especially if the stock market actually corrects. So, I mean, just because things are down doesn't mean that they can't be down by more. So you had better make sure that you've got some diamond hands to be able to hold through that stuff. And the only way you can do that is if you really truly understand the protocol and the token, and you've got a high level of conviction because you did the research, your investment thesis you believe to be correct. No one can do the research for you. Like, if you're, hoping that someone's going to come and save you and tell you, hey, this token's going to do this, or that token's going to do this, no one knows. No one can do the research for you. You have to build the thesis yourself.
Okay, let's bring this all home with what is honestly the single most powerful mental shift you can make as a trader. This one idea can reframe your entire goal in the market. This slide says it all. The amateur, the gambler, they think in certainties. This is a sure thing. I'm betting the farm. The professional thinks in probabilities. This looks like it has a good chance of working out, so I will risk an appropriate amount of my capital to find out.
Right.
See the difference?
How much are you willing to risk to find out if you're right? That's the question you got to ask.
It's a total shift from raw emotion to a disciplined process. And that leaves us with the ultimate takeaway. This is the question you need to burn into your brain. Stop asking yourself, will this go up? And start asking, how much am I willing to risk to find out? The moment you make that shift, you stop being a gambler who bets on outcomes and you become a professional who manages risk. And that, my friends, is the only way to survive and truly thrive in this game.
That's right. What a great piece of video content right there. So that was lesson 6, the video content for lesson 6 in the investor mindset course. And this is totally free, by the way, at courses.defyuniversity.xyz. Totally free. Anyone can go through all of this content. It's just, how badly do you want it? How badly do you want to build a skill set? So once you learn how to assess,
if you're going to invest your money, which is basically time, I would think that you'd be willing to spend the time to educate yourself to do it successfully. It just kind of seems like a no-brainer to me.
Well, yeah, I mean, but you're smart. Like a lot of people,
I'm SMRT.
I know. Well, I think a lot of people need to go back to the Leering Center because, look, no one can want it for you more than you want it for yourself. And if you're, if you're investing your hard-earned, dirty, filthy fiat, well, then, you can't lose it. And the only way that you can actually invest and, build a portfolio properly is if you first build the skill set. You've got to do that first. Otherwise, if you build on a foundation of sand, your building might collapse at some point. So
absolutely,
let's learn here about
Well, really quick, I want to a little bit of breaking news. It looks like Arrow just posted and said, because this is like double what it has been. I've been actually holding out, doing another lock to see if these flight school bonuses would go up. So it looks like the next flight school bonus is slated to be 23%. So I haven't seen it this high in a while. So I might be looking at, because this flight school bonus is ending next month. And, with the new platform coming, this is on top of. So if you do a lock of 2,500 Arrow or more, then this is a bonus that you get. And there's also ways that you can get a multiplier, like a 1.2, 1.3 multiplier, but it's an airdrop. So if you do, 2,500 or more Arrow tokens, then you get automatically, within that window of, for the flight school window, you get an additional free, and this is part of the fees generated off of the platform. They get, that VE arrow holders get. This is part of that. So this is, where some of, those new tokens go. So yeah, this is going away though. It's the 8th of April is the last one. So if you're interested, not saying do it, but if you're interested, this is something that I have personally been doing, and it's been actually probably one of my best investments. Is my arrow locks as far as compounding yield, because it compounds weekly. So I'm actually up nicely on my, even though arrow's taking a dump, I'm actually up nicely on it. Just because of taking profits and having these locks and compounding my position size. I'm like, I've doubled my position size from locks and taking profits and buying back in on dips and things like that. So anyway, let's get back into what David was presenting. I just wanted to share that real quick.
Hey Mike, can I share my screen about Arrow real quick? I've got something here. Yeah, let me grab a trading view. So let's just take a look at the Arrow token just real quick here, because I think that this could be something worth checking out. In fact, I don't want to take a look at the Bybit. I'm looking for Arrow USDT, but maybe so Arrow AERO. There it is, AERO. Perfect. Arrow USDT. I can use the KuCoin contract. Okay, so this is a daily. This is Arrow, and this is a daily chart. Now, it doesn't have all of the data. There is more data going back to August of 2023. So I was on the Aerodrome DEX right when it launched, like the week it launched in August of 23. Okay. And what the Arrow token did right after it launched, and after it launched, remember, that was before Coinbase announced their investment in Arrow. What the token looked like before Coinbase announced their investment, the token looked like this. Yeah. So this is what the Arrow token looked like, and then Coinbase.
I wish I would have known about it, and I was in DeFi and bought it back then, but I wasn't in DeFi yet, so I had no clue about Arrow.
Well, so yeah, I mean, this is the black token for the black hole DEX, kind of like throw your money into the black hole, right?
Yeah.
But after Coinbase announced their investment, the Arrow token did one of these. So that's what the Arrow token did back in February of 2024. And so that's what I want to highlight here. Let me go ahead and zoom out to a weekly on this chart. Okay. And so we don't have all the data here. In fact, I want to bring up Bybit. So Arrow USDT, I'm just going to bring up Arrow on Bybit. Oh man, I want more data. Arrow USD. Let me just see what the Coinbase data. Perfect. There we go. Perfect. So this is the Coinbase data.
There's the run up after Coinbase.
So you see that that massive run.
Yeah.
So now let's go ahead and throw down horizontal support. You see that level of support there?
Yep.
So now that
somewhat at now.
Exactly. So let's zoom in now to a daily chart, and then we'll be able to see something interesting here. So now that we're zoomed into this daily, I want to focus. Let me grab my arrow tool. I want to focus.
All right, David. I need you to whisper sweet nothings to me. Tell me.
I know, right? I want to focus on this. So you see this move, how fast this move was to the upside?
Yes.
So whenever you see big moves like that are quick, you can also see the exact same thing repeat on the way down.
Yeah.
So my expectation for Arrow is that, number one, because it is an altcoin, and that means it's volatile. My expectation is that if Bitcoin breaks its 200-week moving average, I think all altcoins will get sold. And so that means that if Bitcoin breaks its 200-week, well, then that level of support at roughly 27 or 28 cents for Arrow,
Very
if
well could break.
that would likely break, and then I think the move for Arrow would be down to 13 cents or so.
All
And
right.
I think it could happen quickly simply because this bounce, this huge, beginning of this parabolic move,
Mhm.
this happened over the course of like 2 sessions. So I think if it breaks down, it could go, basically from 27 to 13 in a straight shot.
Okay.
So that's
No, and
yeah.
that's, I mean, like I said, I mean, I'm bullish on Aerodrome, the project, but we're gonna be honest here. And that's why I love the back and forth that me and David do. I don't know technical analysis, and I'll be honest. If Arrow goes down to 13 cents or anywhere in the teens, I'm backing the truck up because I do not see Aerodrome going away personally.
No, neither do I. Neither do I. I don't see it going away at all. Um, I'm just not convinced that in a bear market that the token will perform well. I think that we'll likely see much lower lows for the Arrow token at some point this year. But if you continue to believe in your investment thesis, well, then that's maybe you decide that you want to take a much larger position. So yeah, you see what that comment is about Arrow mechanics harming it
Yeah,
in bear runs. Oh, and my trading view screen just bounced off again.
Arrow
Yeah,
mechanics
so
harm it in bear runs. I believe it has increased emissions in bear markets and decreased emissions in bull. That's interesting. I mean, are you able to dissect that?
what I know of the mechanics of the Arrow token um, is that I think that not Scoot Boy. I think that he could be right. He could be right about that. That it's less inflationary on the way up than it is on the way down. But another thing, though, is that look, it's a reward token, and so that means that there's always going to be selling pressure because when most investors who provide liquidity on the Aerodrome DEX receive the Arrow token as a reward, they want dollars. So there's always this demand to sell Arrow, um, especially if it continues to decline in US dollar value. So my expectation for Arrow would be that, even with all of the tokenomics and the way that VE33 DEX, runs, my expectation is that Arrow trades well below 10 cents this year. That's my expectation for the token. And you can blame it on emissions. You can say that emissions increased, emissions decreased. I don't think it matters. I think that the only thing that matters is what Bitcoin does. And if Bitcoin breaks down below 50K, first below its 200-week moving average, but then below 50K, if that happens, I think Arrow and all altcoins move sharply lower. So yeah, I'm kind of calling for Altmageddon at some point this year.
Okay.
That's kind of what I think.
I actually put that into a AI prompt that I do use for research. So I'm going to see what it has to say. I'm just curious. So it says understanding Aerodrome Finance's mechanics. Aerodrome Finance Arrow operates as a VE33 style DEX on base, inspired by models like Velodrome and Solidity. Its core mechanics resolve around token emissions, inflationary rewards distributed to liquidity providers, vote escrow locking, that's the VE Arrow, and a flywheel where VE Arrow holders vote on emission allocations to pools, earning fees and bribes. Emissions incentivize liquidity, but they can dilute token value if not offset by demand, fees, or locking. A key feature in the rebase mechanism, which rewards VE Arrow holders proportionally more when locking rates drop. So that would be during low demand periods, encouraging participation to counter dilution. Emissions follow a structured schedule, starting with an initial ramp up, followed by decay, and then community governance via ArrowFed. This voter control allows dynamic adjustments based on market conditions rather than automatic ties to bull-bear cycles. Recent data shows emissions often balanced or exceeded by locks in early 2026, with locks reducing circulating supply, leading to functional deflation in efficient periods. As of late February 2026, the protocol emphasizes efficiency. It looks like $1.50 of revenue per $1 emitted, 11% annualized inflation, 8% net of locks, and stabilized emissions to support growth. So let's see. Do mechanics harm arrow in bear runs? Partially, yes, but mitigated. In bear markets, low demand, falling prices, or TVL, fixed or high emissions can indeed dilute value if new tokens flood the market without offsetting buys or locks, leading to price pressure. For example, continued emissions without matching revenue can exacerbate sell-offs, as seen in Arrow's 10% plus slide in mid-February. 2026 amid bearish momentum. However, it isn't inherent harm from the mechanics themselves. The rebase rewards lockers more in low lock periods, which is why we're probably seeing the flight school bonus pump. They're trying to incentivize people to lock more. Common in bears, and incentivizing supply removal. What I just said. AeroFed allows voters to cut emissions, reducing inflation, the opposite of harm. Historical data shows locks often exceed emissions in down periods. So again, because of the way that the mechanics work, they actually incentivize people to remove Arrow from circulation. So instead of selling, they're incentivizing people to lock more of it so that it isn't available to dump on the market. So I would disagree with that statement. From everything that I'm reading, the mechanics actually incentivize or mitigate, not necessarily guarantee, but it mitigates the dumping of Arrow in down.
The dumping. So much dumping.
Stop the dumping.
There's so much dumping, Mike. Yeah, man. I'll hold my tongue when it comes to Arrow moving forward.
Oh, no. I don't want you to. You know me. When it comes to the red pill, when it comes to any show, I don't want an echo chamber. I want people to poke holes in things. I want people to tell me everything that's bad about the projects that I'm invested in. That's what makes this show different. I detest fucking echo chambers.
Oh, me too, man. Me too. So here's the thing. I don't believe that the tokenomics are bad. I don't think they're bad. I just think that the only thing that matters is what Bitcoin does in a bear market. I think the only thing that matters is price. That's the only thing that matters. And so it could have the best tokenomics in the world and be a great protocol on the base chain, backed by Coinbase, and a bright future ahead. But price is what matters. And so I see.
Well, price matters when you buy. Price matters when you sell. It's price matters. But the antitheses to that is that like Bitcoin at the beginning. Everybody was like, and I was one of them. I'm like, it's a digital Pokemon card that dorks trade in their basement. That was my exact quote when my buddy told me about it in 2011. I believe it was 20.
Yeah.
Yeah, I just gotten back off my last deployment, and I was sitting at a barbecue, and my buddy was like, "Hey, there's this Bitcoin thing, and let's both put $100 in it and see what happens." And I'm like, "Dude, not a chance." It's like I got better things to do with my money, and of course, I was investing in real estate and stuff like that. So it's not like I did poorly, but I would have done a lot better if I would have bought $100 of Bitcoin back then.
Sure, yeah.
But he did. And last I talked to him, he wasn't able to access it. He lost access to it, but he had $500,000 of Bitcoin.
Man, so that's such a shame.
But these are very new assets. They're very new protocols. We're still in price discovery. We're still in a speculative market. These prices, arrow included, when price is discovered, it could be much lower. We don't know. This is all a gamble, and that is the gamble of being an early investor in these emerging technologies. Is yes, you might hit the Google, you might hit the Amazon, but you might hit the Yahoo, you might hit the pets.com. It's you don't know. So nothing is guaranteed. All you can do is do your research, work on your knowledge, use DeFi University and increase your odds of picking the Amazon, the Google, the Microsoft, because that is the best that you're going to be able to do. Nobody has a crystal ball. My portfolio is a little more risk on. Do I see great things for Aerodrome? Yes. Could I be wrong? Absolutely. I'm invested in a couple of different ones. Canton, is Canton a great project? Absolutely. Is there, a very clear mechanism in place in the tokenomics that rewards me for holding Canton? Not really. I'm using the Braun wallet to earn, free Canton by holding it, but that's not directly tied to the tokenomics or the mechanics. That's through a third party who is running a node or something like that to incentivize people to use their wallet. So you need to understand these things. I'm willing to take that risk because Canton has been rock solid price wise, compared to everything else. It's up, overall, compared to when it launched. It was one of the fairest launches I've ever seen in crypto. The team and early investors got 0 tokens. All the tokens went out into circulation.
It's sitting right now. CC is sitting right now at trendline support.
Yeah.
Yep.
And if you look at the chart, the price of it, it's just freaking, when everything else has been dumping, it's just trending sideways. It's probably been, and I'm up, a good percentage on on my investment because I got in pretty early. But I hats off to the people who were buying down in the 5-6 cent range. The kind of the all time low. But I'm just continually stacking Canton, using my Braun wallet.
Yeah, when I see in the chat, there's a couple of guys talking about Link, and asking us to dump on Link a little bit. Okay, I can dump on Link a little bit. So, what I see out of Link is that the Chainlink protocol is yeah. Let me go ahead and share my trading.
If you're using that tab function in StreamYard, you can just click to the different tabs and then share that tab instead.
Yeah, so I've got the Trading View app open. I could probably open it on my
okay.
So on my browser.
Gotcha.
Yeah, but so what I'm looking at here, this pattern. You see this pattern here?
Is that Canton?
Oh, this is Link. This is Link.
Oh, sorry. Yeah, okay, go ahead.
Yeah,
I was
no, Canton looks a lot better than this.
Yeah.
But for Chainlink, this is a bear flag. So if I go ahead and draw this in, here's the pole, here's the upsloping flag. So that there is a pretty well-defined bear flag pattern. And so if that confirms, then it would bring Link down to like maybe $2, maybe $1 or so. You might see it find some support first at the lows from last bear cycle, which come in at like $4.55. That's where you would expect Link to first find some support. But that's still a pretty big move on the downside. We're talking about 47% to the downside. So that would be really the first big level of support for Link. Now here's the thing. Chainlink is extremely useful as a protocol. But
it's used all over the place. They're partnered with Swift and Linea to update, their services. It's part of Canton. Canton. It's the interoperability layer, one of the interoperability layers with Canton, amongst many others. I mean, Link is all over the place. However, how does that translate to token holders? Really, no way whatsoever.
How does Link's partnerships and Chainlink's usefulness in the ecosystem translate into number go up? Like how does that work? Because this is not like buying shares of stock in a company.
Oh,
it's not. Yeah,
I cannot stress that enough, and I'm going to keep saying it. I know I say it all the time. These assets are not securities. There was that whole lawsuit with Ripple and XRP, and I'm going to keep saying this because it's so important that people understand this. These are not stocks. Stocks, securities, same thing. They are not stocks. There is no fiduciary responsibility for these companies to ensure that you profit. If it was a stock or a security, they would be legally obligated and criminally liable if they don't do their or they're not actively trying to ensure that you profit. So there was that lawsuit, and it's bullshit because we all celebrated it. I was one of them because I didn't fully understand that, because supposedly when, Ripple won the lawsuit, XRP was going to $1 million. And we won the lawsuit and it didn't even budge. And I started to do my research. And what I found out was that we wanted it to be a security because then holding XRP would have been, and this is true of all assets. I'm not just beating up on XRP. It's just they were the lawsuit. It would have ended up being a stake in the company Ripple, which they are doing awesome things. They're acquiring companies. They're trying to become a bank. There's a bunch of stuff that they're doing. So the only way that we as token holders can profit from holding these tokens is through staking, through DeFi, through the tokenomics of the project, to where revenue is shared with us in some way. And that's one of the reasons that I'm bullish on Arrow is the revenue, 100% of the revenue that's generated. And again, don't buy it. I don't care. I'm just telling you what I know about Arrow. And it's just one of the ones I'm knowledgeable about. That's why I'm using it as an example. 100% of the revenue, and this is something Uniswap is starting to do. I don't know if it's 100%, but they are going to be sharing revenue, the fees generated from the protocol, to go to token holders. I'm not quite sure how Uniswap's going to do it, but Arrow does it through paying yield to the VE Arrow locks, the people that are providing liquidity, to give that deep liquidity for the protocol. Does that mean that, there's guaranteed profit? No. Like David said, the price could go even lower. It could go higher eventually.
I think there's more dumping ahead.
And that very well could be, but that is what you need to decide is the risk you're willing to take for the potential upside. Do you believe in these projects, these tokens, long term that you're invested in? Or, are you going to be susceptible emotionally to short term, losses? If Arrow dips down into the teens, what is that going to do to you mentally? Is that going to, emotionally charge you to be like, screw this, I'm out? Because if that's the case, you might want to get out now.
Yeah.
Again, I love Arrow. I want the price to go up. I don't, necessarily want people to sell, but I'm honest. You need to be honest with yourself. If look at your holdings. If you lose another 70, 80%, are you going to sell? Are you not convicted enough in those investments? And if so, this might be a good time for you to shift over into Bitcoin or Ethereum or something safer, maybe even fiat or stables. That's up to you. You need to decide that. But David, do you have input on that?
Yeah, I'm short. So, I'm watching.
Well, I don't want no short man.
Yeah. So I'm short, man. So, that's my perspective here is that it's a Bitcoin bear market. and that means altcoins are going to get just slaughtered, even though they've already, been sold. I really think that we have not seen the lows yet this year, and so I expect much, much more downside ahead. But in order to deal with that downside, you've got to start to think in terms of probabilities. So, Mike, I've got my screen share running for this tab, and I think this will be kind of interesting. So, this is developing probability-based thinking.
Yeah, we got about 30 minutes left, so let's bust out some more.
Yeah, this will be good, man. This will be good. So let's go ahead and play this content. Just let me know if you can hear
everyone,
this.
And welcome. Today we're going to talk about the single most important mindset shift for anyone who's serious about making it in DeFi. It's all about learning to stop being the gambler at the table and start becoming the casino. And trust me, this is literally the difference between consistent profit and consistent pain. So when you really get down to it, there are only two ways to approach DeFi trading. On one side, you've got the gambler. They're all about certainty, they run on hope, they're protecting their ego, and they love making these big, bold predictions. But on the other side, you have the casino. They couldn't care less about predictions, they operate on pure probability. They hunt for statistical edge, they rely on systems, and they live and die by one number, expected value. Now, one of these approaches almost always loses money in the long run, and the other one almost always makes it. So why do so many of us fall into that gambler's trap? Well, it's pretty simple, actually. Our brains are basically hardwired to play this game completely wrong. We are wired to crave control and certainty, but we're playing in an arena, the market, that is fundamentally uncertain and chaotic.
Right.
This massive disconnect, it leads to some really, really destructive psychological traps. Okay, first up, let's talk about prediction addiction. This is the belief that you can, and you should, be able to predict exactly where a price is going. It completely turns trading into a form of fortune telling. You're not analyzing anymore, you're just guessing. And you're hoping you're right so you get that nice little ego boost.
So, Mike, have you ever used divining rods before?
Do you know actually, my grandpa, he did it as one of his occupations. So those of you that, he ran moonshine too, but yeah. Divining rods, if you don't know, they're usually like metal rods that they hold, and supposedly he was very successful at it, but mostly to find water, like where to drill for a well. And they hold these rods, and they'll just kind of drift, and whenever they cross, then supposedly that's where you drill. So
exactly. So what I'm thinking of doing here is, when I really want to start to buy, what I'll do is
put your divining rods over your laptop.
Exactly. Tell me which token to buy. Basically, man.
We need to have the Node Ouija board for crypto investing.
100%. We really do.
But here's the kicker. The market could not care less about your predictions. All right, next we've got outcome fixation. This is where you judge how good your decision was based only on the result. Think about it. You ape into some random meme coin, do zero research, and bam, it pumps. You get lucky. Your brain immediately files that away as a great decision, which just reinforces a
analyzing and not getting analyzed.
Terrible habit. A professional knows that a good process can sometimes lead to a loss, and a terrible process can get you a lucky win. They are obsessed with the process, not the random outcome. And the third trap, and this one's a real silent account killer, is certainty seeking. It's that feeling of waiting for the perfect setup, the sure thing. But let me tell you the hard truth. There are no sure things in this game. And while you're sitting on the sidelines waiting for that perfect moment that never comes, you're missing out on actual, real opportunities that have a good probability of working out. And this all boils down to one single unavoidable truth. There is no certainty in markets, only probabilities. Embrace this or be destroyed by it. You either accept this reality and learn to play the game the right way, or the market will just keep taking your money over and over until you finally get the message. Okay, so we've established that the gambler's path is a road to ruin. So what's the alternative? How do we flip the script? Well, we have to start thinking like the house. We have to adopt the mindset of the casino. A casino is totally detached, it's systematic, and it is purely 100% driven by probability. See, a casino doesn't sit there hoping you lose. It doesn't need to. It knows that over thousands and thousands of bets, its tiny little statistical edge is a mathematical guarantee of profit. So what does this actually look like in practice? Well, a probability thinker doesn't say, I know this is going to moon. No, they start by just acknowledging uncertainty. They're not focused on this one single trade, they're focused on their statistical edge over hundreds of trades. When they look at a chart, they're not trying to predict the exact top. Nope, they're seeing a range of possibilities. And, crucially, they get that a super high APY isn't a guarantee. It's just the market's way of telling you there's a super high risk involved. They win by just playing the odds, again and again and again. And that brings us to the absolute bedrock of this entire mindset, the one number, the one tool that separates the pros from the amateurs. It's called expected value, or EV for short. So what exactly is expected value? It's actually pretty simple. It's just a quick calculation that tells you, on average, how much you're going to win or lose on any given bet if you just kept making it over and over and over again. It takes all the possible things that could happen, weighs them by how likely they are to happen, and spits out a single number that tells you if a bet is actually profitable in the long run. Now here's the formula, and I know, it might look a little scary at first, but trust me, it is super simple. You just take the chance of winning and multiply it by how much you stand to win. Then you subtract the chance of losing multiplied by how much you could lose. That's it. The number you get tells you if you have an edge or not. Okay, theory is great, but let's make this real. Let's walk through a DeFi example. Imagine you're putting $500 into a new protocol. You figure there's about a 30% chance it does a 5x, which would be a $2,000 profit. That means there's a 70% chance it kind of fails and you lose half your money, a $250 loss. So first, let's take that potential $2,000 profit and multiply it by its 30% chance of happening. That gives us a weighted value of a positive $600. Then we do the same for the loss, which gives us a negative $175. Okay, now for the magic. We just add those two numbers together, the positive $600 and the negative $175. And what do we get? Positive $425. That is the expected value of this trade. And this is the whole point. Even though you're actually more likely to lose money on this specific trade, it is an insanely profitable bet to take in the long run. If you found 100 bets just like this, the math says you would come out way, way ahead. This is thinking like the casino.
So, being able to calculate EV is your new superpower. But to do it right, you need a few more tools in your belt to help you nail down those probabilities in the first place.
First up, and this one is huge, is understanding something called base rates. A base rate is just the historical success rate for things like this. For example, data shows that only about 5 to 10% of new tokens actually succeed long-term. That's the sober base rate. But then we find a project we just love, right? And our hopium kicks in, and our personal estimate jumps to like 90%. This huge gap between reality and our hopes, that's called base rate neglect, and it is a total portfolio killer.
So that's the big question, right? How do we take new information about a project, good news, without just fooling ourselves with hopium and completely ignoring the facts?
The answer is to use a system. It's called a Bayesian update, and it's all about being methodical. You always start with the cold, hard base rate. Let's say 20% success for a new type of protocol. Then you systematically adjust that number based on new facts. Does it have a really strong known team? Okay, maybe we add 15% to our probability. Did it pass multiple tough audits? Great, let's add another 10%. By doing this, you end up with a new, more informed probability that's actually grounded in reality, not just your excitement.
Okay, so once you get the hang of thinking in probabilities for a single trade, you can zoom out and apply this to your whole portfolio. And this is where you move from just predicting to actually preparing. So look at the difference here. The predictor, they say something super specific, like ETH will hit $5,000. It sounds confident, but it's actually really fragile. The preparer, on the other hand, thinks in ranges and probabilities. They'd say something like, I'm about 70% confident that ETH will end up somewhere between $2,000 and $6,000. It acknowledges that you don't know for sure, and it's a much more humble and, frankly, a much more useful way to see what's coming. And this chart shows you exactly how the pros put this into action. They don't bet the farm on one single outcome. Instead, they assign probabilities to multiple different scenarios: a raging bull market, a choppy sideways market, a nasty bear market, and then they build a portfolio that can do okay, maybe even well, across most of those futures, instead of going all in on just one.
All right, we have covered a ton of ground. We've talked mindset, the core math, the mental tools, so let's bring it all home. How can you literally start doing this with your very next trade?
This right here, this is your new pre-flight checklist. Do not, I repeat, do not make another trade without running through this. Number one, calculate the expected value. If it's not clearly positive, you just pass. It's that simple. 2, consider the base rate. Anchor yourself in reality first. 3, think through a few different scenarios for how this could play out. 4, express your confidence as a range, not a single certain number. And 5, and this is so important, size your position based on the math, based on your probability and your edge, not on how excited or emotional you feel. So let's leave you with this final thought. From now on, I want you to stop asking, is this going to pump or is this going to a million? Instead, I want you to ask a
David.
profitable question.
What's that, Mike?
Really quick, number 4 on that, it was talking about selecting a range, not a specific price, which we've gone over in the past is a red flag. Anytime that you hear anybody saying, this token to this price, it is an immediate red flag. But understanding a range, being able to look at historical data, actual data and charts, and be able to see a range that is above or below, whatever price it's currently at. That is what you want to focus on, because then you can say, okay, well, if it moves up and it's able to get back into that range or that level of support or resistance, then I could realize that profit. So that is a more realistic expectation than some moon math, price point. So sorry, I just wanted to kind of bring that up and kind of tie together some older lessons to these newer ones.
100%. So, the way that I like to think about ranges is always the lens of technical analysis. So I'll take a look at a chart. Maybe I'm looking at BTC. I see a breakdown at 74.5. And so since price broke below 74,500, that becomes resistance. So I've got my resistance on the upside. And then below, where's the support? Well, it's that low from a couple of weeks ago at 60K. So we've got support below at 60, resistance above at 74.5. And so now I just say to myself, okay, well,
do I think it's going to be long or short? Do I want to take a long or short?
Exactly. What do I think is more likely for Bitcoin to touch 74 or 60?
So basically what David, to kind of, summarize what you're talking about is those at 74 and I believe you said 60 something, basically that would be, depending on if you're long or short, that potentially would be where you would want to take profit is, because it might reject off that. If it goes higher, whatever, you made your 10% or you made your profit. So, if it goes, lower, it's like, yeah, you didn't time it perfectly and, catch the swing or catch the dip, perfectly, but you made your 10%, you made your 20% and you got the hell out. That's a win. You don't have to, catch all of them perfectly, to where, you're getting the maximum amount of profit and the max, on the upside and the downside. Just get a good, 10%, 20% and get the fuck out.
Yeah, I think that's a pretty good idea. Certainly try to do that as often as possible.
3, think through a few different scenarios for how this could play out. 4, express your confidence as a range, not a single certain number. And 5, and this is so important, size your position based on the math, based on your probability and your edge, not on how excited or emotional you feel. So let's leave you with this final thought. From now on, I want you to stop asking, is this going to pump or is this going to a million? Instead, I want you to ask the single most profitable question you can ask in DeFi. What's the expected value?
Right.
That one question, that one shift from chasing certainty to calculating your edge, that's the whole game.
Expected value, man. So thinking in terms of probability, that is the way to do it. All right. So we've gone through a little bit about the psychology of risk management. We talked through developing probability-based thinking. Let's take a look at some of the cognitive biases that we can all fall for, because I'm sure that you're going to see in this video content that, hey, there are a lot of these cognitive biases that I'd be willing to bet that you've fallen for, because I fall for them all the time and I know what they are. It's, it's such a weird thing. So this will be a good one, and we'll be able to.
It's in our nature to seek out, basically things that support our way of thinking, or when it comes to religion, personal interactions, investing, whatever. we're pack animals. Humans are pack animals. They seek out like-minded individuals. It's just in our nature. It takes discipline and it takes a conscious effort to seek out opposing views, and it's why it's so healthy, because you get a much more well-rounded and informed a picture of whatever it is, and you are able to make a more accurate and potentially a more successful investment decision with a fuller picture. So,
Yeah,
sorry,
100%. 100%. And so there's a handful of biases here that the video content's going to go through. Confirmation bias is one. I'm sure that, we probably know all about this one, right? Where you stay in that echo chamber so that you can only hear confirming information that tells you what you want to hear. So confirmation bias, this one's dangerous. FOMO, this one's dangerous too, because you're just acting on that fast emotional system one. And basically whenever you experience FOMO, if you experience FOMO after seeing a big green candle, you need to do the exact opposite and sell that big green candle. So a loss aversion is another one. Let's see. So those are the big three. Here are the secondary six. Anchoring. So that's when you anchor your thoughts to the first piece of information that you see. Herd mentality, just following what someone on social media told you to do. Overconfidence.
And that's a lot of when I talk about an echo chamber, it's basically just being in a chat room or a physical room or whatever, just with a bunch of like-minded people that just tell each other what they want to hear. You give each other one.
It goes something like this. XRP is great. Oh yeah, XRP is awesome. And then that's all you hear. If you're in that echo chamber and that's all you hear, then guess what? What are you going to think?
And somebody's going to say some buzzword or some like the ISO narrative where they're ISO compliant. It's ISO compliant. You're going to hear everybody like you see on social media. Like, oh, these are the projects that are ISO compliant. They're the ones that are going to go to the moon because they're ISO compliant. And most people will just believe that without doing any research or even knowing what the hell ISO 20022 is.
Right. And, so it's going to sound something like this. Oh, well, it's ISO compliant and the real world assets, the RWAs and the partnerships with the Fed and, going to the moon, don't you know? And whenever you hear like all of those buzzwords all jam packed into the same paragraph, that's such a red flag, man.
Giant red flag.
Giant red flag. So let's watch this video content. I think this should be an interesting one about these cognitive biases.
You ever look at your portfolio and just wonder why you're losing money in DeFi, even when you feel like you've done all the research? Well, I'm going to tell you, the answer probably isn't in the charts. It's right inside your own head. Today, we're diving deep into the cognitive biases that are secretly costing you a fortune, and more importantly, the practical tools you can use to stop the bleeding. There's this killer quote from the trading legend Jesse Livermore. The market does not beat them, they beat themselves. And that is the absolute brutal truth of DeFi. The biggest battle you're ever going to fight isn't against a bear market or some new protocol. Nope. It's against your own predictable, hardwired psychological errors.
Right.
So what's the...
And so just real quick, Jesse Livermore, he wrote a series of articles that were combined together into a book called Reminiscences of a Stock Operator. And Reminiscences is usually referred to as like the trader's Bible. It's about Livermore's career, from 1910 to 1950. And he's a legendary trader because he made a killing during the stock market crash of 1929. So his book is definitely worth a read. I think I've probably read it 10 times. So definitely worth reading that one.
Core of the problem here. It's pretty simple, actually. Our brains are running on software that's ancient. It's hardwired for survival on the savannah, not for the insane 24/7 volatility of crypto markets. Your brain's default setting is designed to keep you from getting eaten by a tiger, not to make you rich in digital finance. And that fundamental conflict, that's where all the expensive mistakes start.
So to fix this, we've got to diagnose the problem first, right? Let's kick off a little personal bias audit. It's time to meet the 3 biggest money destroyers out there, the ones that are probably costing you money right now. Okay, first up, the account killer, confirmation bias. This is your brain's sneaky tendency to hunt for information that confirms what you already want to believe. At the same time, it conveniently filters out or ignores anything that challenges your idea. It's like you're building a personal echo chamber where your investment idea can never be wrong until.
What's that, Mike?
Really quick, the confirmation bias. It's an easy trap to fall into if you always go to the same sources. If you find sources that give you those warm fuzzies, because it makes you feel good, and you just always go back to those same sources. It's why it is so important to find contrarian points of view and to pull your information from actual data that's not for or against, and seek out people that are maybe positive about the project and people that are negative on the project, so you have a fuller picture. So sorry. Oh shit, David. We lost David. David, where'd you go? Come back, David. We'll see if he pops back in. Looks like he might have lost his internet or something. We only got about 9 minutes left, but no, it really is important that, let me pop over to this. It really is important that we don't fall into that trap. Fall into that trap of finding the chat rooms, finding the shows. All right, there he is.
Problem with my browser.
Oh, okay. Let's add you to this. All right. Go ahead and bring that screen back up, and let's go ahead and finish that. We got about 9 minutes left.
All right. So confirmation bias. Yeah, my bad, Mike. It just problem with my browser there.
Till it is, and everything collapses.
And this isn't just some abstract theory. The real-world cost is absolutely staggering. I mean, just look at the Terra/Luna tragedy. Investors were laser-focused on all the optimistic tweets from the founder, building this powerful story in their minds. All the while, they were actively dismissing clear, credible warnings about the huge systemic risks. They were looking for confirmation, not truth.
Right. So the funny thing about Terra Luna is that for like a year leading up to the collapse of Terra Luna, there were really well-known people in crypto who in public at conferences were saying that it's going to collapse, and they were saying exactly how it was going to collapse, but no one wanted to listen to them though.
And that dude got the tattoo of the wolf with the moon or whatever, the Luna, the Luna moon.
Oh my goodness. Yeah, man, that was a thing. Yeah. What a shame.
I think it was the founder that got it.
Wouldn't surprise me. I don't remember that particular piece of information, but what I remember,
I was pretty new to crypto, so I mean, I was definitely in the DGen, chat rooms and the DGen shows, watching all the different goings on.
Oh, for sure. I mean, that's where the fun is, or at least that's where the fun was.
That's where the entertainment is, for sure.
Yeah, it definitely is. It was just such a shame that there were so many people that got hurt by that, and it was avoidable. And there were experts out there saying like, hey, this thing is nonsense and it's going to collapse. And here's how it's going to collapse. But people didn't listen. They didn't listen. They stayed stuck in the echo chambers, and just sought confirmation bias.
And it led to a complete and total wipeout. So here's a quick gut check for you, and be honest with yourself in this one. Do you automatically dismiss negative news about a coin you hold as just FUD? Fear, uncertainty, and doubt? If your immediate reaction is, that's just FUD, there's a really good chance you're living inside a confirmation bias bubble. Now, while that first bias convinces you to ignore all the warnings, our next one pushes you to just throw your whole strategy out the window. Say hello to the momentum killer, FOMO, or fear of missing out. This is that anxious, compulsive feeling in your gut that you are missing a life-changing rocket ship, and it drives you to make urgent, irrational decisions, almost always at the worst possible time. And the perfect textbook case study for this is the Dogecoin delusion. People saw the price going vertical. They saw screenshots in social media of people making crazy money. So, driven by nothing but pure FOMO, they piled in at the absolute peak with zero understanding of what they were even buying. They were just left holding the bag.
So ask yourself this. Do you find yourself buying after a massive pump, telling yourself, oh, it's still got room to run, it's still going up? Yeah, that's not a strategy. That's FOMO doing the thinking for you. And finally, we've got the silent wealth destroyer, loss aversion. Here's a crazy fact from psychology. A loss hurts about twice as much as an equivalent gain feels good. Let that sink in. This deep-seated fear of realizing a loss, of making it real, causes us to make truly terrible decisions, like holding on to our losers for way, way too long. I mean, think.
Yeah, so that's something that a lot of people do. So let me just back this up here real quick. I want to take a look at this. So loss aversion. Something that's funny about this is that not only do losses feel twice as painful as equivalent gains feel good, but also you feel pain from imaginary positions that you never entered. So if you don't even enter a position and then that token pumps to the moon, you feel pain similar to loss aversion from not getting that gain.
Because you missed out.
Yeah, it's such a weird thing. Your brain, my brain all of our brains trick us, man. It's so weird.
And that's why
make truly terrible decisions.
It really is. And just even when you understand this stuff, it still happens. It still happens. So, that's why, taking pen to paper and writing stuff down is so powerful.
It happened with me with XRP. When I sold at $2 and it kept going, I was like, "Oh shit!" I missed out on more profits. Instead of just being happy that hey, my average entry was 34. I sold at 2, made a bunch of money. I should have just been like, "Oh, awesome, moving right along." But no, I for a minute I dwelled on the fact that oh shit, should I get back in? Is it actually going to go to 589 or something like that or but yeah, luckily I did.
Yeah, yeah. XRP to 30 cents, bro.
Yeah.
Decisions, like holding on to our losers for way, way too long. I mean, think about the classic ETH holder's dilemma. Someone buys near the all-time high, then they watch it drop and drop and drop, and they refuse to sell because they just can't stomach the idea of taking the loss. So what happens? Their capital gets trapped, stuck in a losing position, unable to be used for new, better opportunities. This brings us to our last question for this little audit. Do you hold on to your losing positions, just hoping and praying for a recovery so you don't have to actually click the button and make the loss real? If you do, that's loss aversion, and it is silently draining your portfolio. Okay, that was the diagnosis. Pretty heavy, right? But now for the good part, the solution. Let's build our practical bias breaker toolkit. Think of these as the antidotes for your brain's bad habits. So, to fight confirmation bias, you have to systematically force yourself to see the other side. Here's how. First, write down your bull case, why you think this is a great investment. Then, and this is the important part, you have to argue the bear case with just as much passion. After that, go find 3 smart devil's advocates, people you respect who disagree with you. And finally, do a failure audit. Ask yourself, what would have to happen for this investment to go to zero? All right, now for FOMO. The antidote here is incredibly simple, but so powerful. It all comes down to this one magic number, 48. This is what I call the FOMO firewall.
48?
I thought it was 42 from Hitchhiker's Guide to the Galaxy.
Oh yeah. What is the meaning of life?
Yep, 42.
42.
42.
It's about 350.
Yeah.
The second you feel that itch, that urge to chase a massive green candle, you deploy this checklist. Step 1, close the charts. Close Twitter, close everything. Step 2, set a 48-hour timer on your phone. You make no decisions until that timer goes off. This simple pause gives your rational brain a chance to catch up with your emotional one. It's amazing how many bad impulsive decisions this one trick filters out. And how do we combat loss aversion? Easy. You take the emotion completely out of the equation before you even enter the trade. It's called the pre-commitment stop protocol. Before you click buy, you define your exact exit price, your maximum acceptable loss. You write it down. This becomes a contract with yourself, and you have to execute it without hesitation if it gets hit. No second guessing. So, we've got these individual tools, which is great, but how do we turn this into a real lasting habit? Well, that brings us to what is quite possibly the most profitable system you can ever build for yourself. And here it is. This single most profitable habit you can build is just doing a quick bias detection check before every single decision. We're talking 2 minutes. That's all it takes to engage your logical brain and prevent countless expensive mistakes. And this is the checklist. Before you click buy or sell, you just run through these questions. Am I just looking for reasons to be right here? Is this trade being driven by Twitter hype? That's FOMO. Am I hanging on to this thing just because I hate being wrong? That's loss aversion. Every single one of these questions is like a guardrail, keeping you from driving your portfolio right off a cliff. All right, last piece of the puzzle. Let's talk about the most profitable mindset. Because here's the thing, you will take losses. It's gonna happen. The goal isn't to avoid them entirely, that's impossible. The goal is to turn those losses into valuable lessons. This is a powerful mental trick called the tuition reframe. You didn't just make a $1,000 mistake. Nope. You paid $1,000 in tuition for a critical market lesson. A lesson that's probably going to save you 10 times that amount in the future. Frame it that way. What did I learn? A loss is no longer a failure. It becomes an investment in your own education.
And let's end with a piece of wisdom you should probably write down and stick on your monitor. The most expensive words in DeFi are not "I was wrong." They are "this time is different."
Right.
Your brain will always, always tell you this to justify chasing a trend or ignoring a risk. Don't fall for it.
Look, your brain's default wiring, the same wiring that kept our ancestors alive, it will cost you money in these markets. That's not a possibility, it's a guarantee. So the only real question left is, what are you going to do about it?
That's right. Man, that was a great video. I really enjoy going through all that video content, Mike. A lot of fun, man. What did you take away from that?
Well, I mean, I know that, and I knew this before, but my weakness is loss aversion. I'll hold, and I've said it multiple times, I'll hold to zero or Valhalla. If fundamentally, if nothing changes in a project, I'll hold it to zero. And it's just something that I've accepted about, my personality, because I don't invest in something unless I'm very convicted on it. And if nothing changes about it, then my thesis shouldn't change. There's exceptions, but it shouldn't change. Now, again, like with XRP, it fundamentally changed. They launched RLUSD. There's a bunch of things that happened that made me decide to get out of it. And I'm glad I did, because I'd still be up right now because, again, my average entry was 34 cents. But you need to understand yourself. You need to be not just critical about the projects, or realistic about the projects you're invested in. You need to be realistic about yourself. You need to, take a good, solid look at yourself, and maybe even ask some people that you trust close to you, that maybe they're into crypto or they're into investing, and have them take a look at what it is that you do in your habits, and say, I need a very real, very raw assessment of what you see that I'm doing wrong, or do any of these apply to me? Because that is how you're going to improve, is finding your weaknesses. This is one thing I've done throughout my entire life, not just in investing. It's like a fetish of mine to find my weaknesses and to push myself to eliminate those. If it's fear of heights, if it's claustrophobia, if it's fear of sharks, if it's fear of commitments, whatever it is, find your weaknesses and attack them with a vengeance. If it's your ego, don't want to be told that you're that you're making mistakes in your investing. That should be a red flag that's what you need to do. So anyway, David, your closing thoughts.
Well, I think that with everything going on in the world right now, that just managing emotion is probably a really good idea right now. So if we get some type of a pump out of crypto and Bitcoin continues moving to the upside, well, take a look at Benjamin Cowan's video content from last night that he posted. So Ben Cowan is probably the best analyst at reading the Bitcoin cycle out there on YouTube. And what he was saying last night was that every bear market in the post-halving, or what is it, in the midterm year. So every bear market in the midterm year, we get some type of a bounce in March. Like markets, Bitcoin puts in some type of a low in Feb, and then in March, we get some type of a bounce, which ends up being a selling opportunity. So I'm just thinking to myself, well, we might get some more bounce out of markets. Maybe, you know, the stuff in the Middle East is the excuse for markets like digital asset markets to bounce a little bit. You never know. It could be the contrarian play. But if it does bounce, I do expect things to roll back over. So I think it's a bear market. And in Bitcoin bear markets, you know, alts get slaughtered and Bitcoin gets sold pretty hard too. So that's my expectation for the rest of the year, that we see further downside. So that's my final comment there.
Awesome. Well, I want to thank everybody that shows up every day, because you know, you're what's, you know, getting this show off on the right foot. We got, you know, a good amount of people over on the arena. Got a, you know, a good amount of people watching on YouTube. I'm still trying to get the YouTube, you know, the
I
node
know.
channel going, and it's just, you know, YouTube and Google are just not wanting to play nice. They're saying that we're not eligible yet. There's some kind of waiting period. So as soon as that goes, we're going to get that up, and that will be the, you know, exclusive YouTube channel that we'll be streaming to. So keep an eye out for that. We'll do a couple of shows, you know, to all the channels, just so that you guys all have a chance to migrate there and follow there. But again, you know, for data and analytics, we want to, you know, keep it, you know, focused. I'm going to end on this because I really like this comment. The lesson repeats until you learn. In the military, the pain will continue until morale improves. That's kind of the military version of that. So basically, you know, if you keep making the same mistakes, you're going to usually get the same result. So act accordingly. Till next time, Veteran Crypto out.
Peace.